99% of consumer AI apps built over the last 3 years are going to zero.
Yeah, they really are.
It's literally an extinction event. The whole era of the $20 a month chatbot subscription is just a graveyard of bankrupt dreamers.
Right, it's over. But at the exact same time, there is this hidden multi-million-dollar generational wealth event waiting.
Waiting in, of all places, commercial flat roofs.
Exactly.
Welcome to MediaGenX. Today, we are doing a deep dive into the 2026 playbook for vertical AI startups, and we're tearing apart the actual mechanics of why all these flashy AI companies are just bleeding out right now.
Yeah, and how solo founders are quietly printing money in literally the most boring industries on earth.
Right. Okay, let's unpack this. But before anyone quits their day job to go build the next big AI tool, we have to talk about the trap.
Oh, absolutely.
Because later in the show, we're going to hit the dark side of this. We're talking brutal psychological burnouts on what they call the AI treadmill, and how relying on big tech giants for your API can literally wipe out 80% gross margins in a single fiscal quarter.
Yeah, it's terrifying out there if you don't know the mechanics.
So let's trace this back. The research we're looking at today focuses on this idea of the great wrapper extinction.
Yes.
And we hear this term AI wrapper everywhere now. Like, why is it dying? Because a year or two ago, solo devs were making millions off these things, right?
You were, yeah. But you have to look at the structural flaw of what a wrapper actually is to understand the bloodbath we're seeing.
Okay, so what is it structurally?
A wrapper is basically just a thin user interface built on top of someone else's foundational model. So think Anthropic or OpenAI. The startup pays for access to that model via an API. They write a clever system prompt behind the scenes to, make the model behave a certain way. And then they charge the end user a monthly subscription.
But wait, if I spend like 3 months engineering an incredibly complex prompt that generates, perfect, hyper-specific marketing copy for real estate agents, that's my IP, isn't it? Like, I created that value.
Well, you've created a temporary convenience. You haven't created structural defensibility.
Okay.
Right? The fatal flaw is that your entire secret sauce is literally just text.
Wow. Yeah.
And text can be copied. It can be reverse engineered or just outright stolen by a competitor in like 4 seconds. You have absolutely no moat.
Right.
But honestly, the bigger threat isn't even your competitor, it's your supplier.
The API provider.
Exactly. The minute OpenAI decides to release a new native feature that does exactly what your secret prompt does, your entire value proposition evaporates overnight. They flip a switch and you're obsolete.
It's like building a sandcastle on land you don't own with bricks you don't make, where the landlord can evict you in a second.
That is a perfect way to visualize it, yeah.
You have zero actual leverage.
None. And this leads directly into the mathematical reality of what the research calls the horizontal trap.
The horizontal trap?
Yeah, a massive portion of these dead wrappers were trying to build horizontal AI.
Meaning general purpose tools, right? Like an AI that writes blog posts for any industry, or like a generic coding assistant.
Correct. When you attempt to build a horizontal AI tool, you are implicitly declaring war on the foundation model providers themselves.
Oh, man.
Yeah, and you're declaring war on massive venture-backed incumbents, companies like Microsoft and Salesforce.
Right, because by trying to be a universal tool, you have to outspend and out-engineer the hyperscalers.
Exactly.
And hold on, just for anyone not deeply technical, let's define hyperscaler. Are we just talking about big tech?
Broadly, yes, but specifically companies with massive globe-spanning cloud infrastructures.
Yeah.
So AWS, Microsoft Azure, Google Cloud.
Right, the guys who actually own the servers.
Exactly. They have essentially infinite compute power and hundreds of billions of dollars in cash reserves. So from a pure business mechanics standpoint, challenging them on general purpose features is a mathematical suicide mission.
Yeah, you can't win a feature war against $1 trillion hyperscaler.
You just can't.
Which totally explains why businesses are still spending billions on AI, but they aren't buying these horizontal wrappers anymore. So if the generic tools are dead, where's the capital actually flowing?
What's fascinating here is how the real money is migrating. It's moving away from the shiny consumer tools and going deep into heavily regulated, technologically stagnant legacy workflows.
Okay, stagnant workflows.
Yeah, because it comes down to a fundamental truth of B2B software. Businesses do not buy parameters.
Right, they don't care about the tech specs.
Exactly. They don't care about the size of a neural network's context window. They buy risk reduction, they buy cost elimination, and they buy revenue acceleration.
They just want measurable mathematical outcomes.
Right. And outcomes are rarely universal. They are deeply specific to a particular industry, a specific regulatory environment, and the exact operational workflow of that specific company.
Which brings us to the vertical AI goldmine.
Yes.
I really want to ground this because the research keeps hammering on this commercial flat roof example.
It's such a good example.
But to me, it sounds incredibly random. Like, why commercial roofing?
Well, it sounds random until you look at how the industry actually operates today. Let's map out the old way, the manual workflow.
Oh, okay.
You have a 60-year-old executive running a commercial roofing company. They're dealing with millions of dollars in contracts, right?
Mm-hmm.
But their day-to-day operations are running on Excel sheets from 2008, massive PDFs, and just endless phone calls. The entire process relies on human cognitive bottlenecks.
So what does that bottleneck actually look like when a new job comes in?
So a general contractor wants a bid for a massive warehouse roof. They send over an architectural blueprint as a PDF. Now, to give an accurate quote, a senior, highly paid human estimator has to sit down and manually measure the square footage on that digital drawing.
Oh, wow. Like literally tracing it out.
Literally tracing it out. And a flat roof isn't just a rectangle, right? They have to count every single HVAC penetration. They have to calculate the slight slope of the roof for drainage.
Right.
They have to cross-reference the current daily spot price of TPO membrane materials, factor in local labor rates, and account for waste.
But wait, why is a PDF so hard for a computer to read? Can't standard software just scan it and do the math?
No, because architectural blueprints are unstructured data.
Okay.
It's not a neat spreadsheet. It's a chaotic mix of lines, symbols, stamped text, smudged annotations. Trying to get traditional software to understand a complex blueprint is like, it's like giving someone a novel where all the words have been thrown into a blender and asking them to tell you the plot.
That's a great analogy. It just doesn't work.
Right, it requires deep contextual reasoning.
And according to the data in this playbook, this process of manual reasoning takes that human expert anywhere from 4 to 7 hours to complete just one single bid.
Exactly. And think about the opportunity cost there. Because it takes 6 hours per estimate, the roofing company can only actually bid on about 20% of the leads they receive.
Wait, really? Only 20%?
Yeah, the other 80% of potential business is just ignored. It's left on the table because the operational cost of estimating those jobs is simply too high.
That is insane. So they're just throwing away revenue because they don't have the human bandwidth.
Exactly. And enter the custom AI.
Right.
Instead of building a generic AI for construction, a startup builds a custom vision language model specifically engineered for commercial flat roofs.
Wow.
It doesn't write emails. It doesn't generate marketing copy. It just does geometry and supply chain math.
That is so hyper-focused.
It is. It ingests that messy blueprint, identifies the roof boundaries, counts the HVAC units, extracts material requirements, and then aligns it with an API that pulls real-time daily pricing of materials.
So what takes a human 6 hours?
This vertical AI does in 4 minutes.
4 minutes? That's unbelievable.
Yeah. And let's look at the actual money angle here, because this is where generational wealth is generated for the founder. Because of this velocity, the roofing company can now bid on 100% of their leads instead of just 20%.
Oh, man.
This translates to a 30% top-line revenue increase for the roofing company. And they didn't have to hire a single new human estimator to achieve it.
Which makes the sales pitch absurdly easy. I mean, you weren't trying to sell a stubborn executive a novelty chatbot for $20 a month. You were selling them a machine that literally prints new revenue.
Yes.
And the startup, in this case study, they charge a flat fee of $2,000 a month for this estimating engine. And the roofing executive pays it gladly because that $2,000 expense yields $20,000 a month in new actual profit.
It's a no-brainer for them. And if you dominate just this one single niche, right, capturing just a fraction of the commercial roofing market across the country, you can create a $5 million ARR, so annual recurring revenue, micro sauce business.
5 million ARR from just flat roofs.
Yeah, and the tech giants are never going to build a bespoke AI for commercial roofers.
Yeah.
The total addressable market is just quote unquote too small to move the needle for Microsoft.
Right.
But for a solo founder, A highly defensible $5 million ARR business with massive software margins is a life-changing liquidity event.
Okay, the math sounds amazing, but let's get practical here.
Sure.
If I'm a solo founder listening to this and I have zero VC funding, how do I actually build this? Like, the big guys have all the GPUs and the engineering talent. Where do I even start?
So you follow a very specific set of mechanics. We extracted 4 distinct steps from the playbook that someone could literally start executing this week.
Okay, let's hear them.
Step 1 is identifying your unsexy niche. You need an industry with 3 specific traits: high revenue per employee, a massive reliance on unstructured data, so PDFs and emails, and severe technological stagnation.
Right, so commercial roofing fits perfectly, but the sources also pointed to things like mid-market freight brokerage or specialized dental labs.
Exactly. You want the hidden quarters of the economy where millions of dollars change hands. But the technology still feels stuck in 2005.
Yeah, where people are still faxing things.
Literally, yes. You're looking for high-stakes logistical or engineering workflows that are bottlenecked by the speed at which a human can read and process a complex document.
Okay, so you find the niche. What's step 2?
Step 2 is deploying the agency to sauce Trojan horse.
The Trojan horse. I love this part.
And the core directive here is highly counterintuitive. Do not build software first.
Wait, really?
Yes. If you are bootstrapping, do not lock yourself in a dark room for a year writing code. You start an agency instead.
But wait, isn't the whole point of a tech startup to avoid doing manual labor? Why on earth would I start a service agency?
Because it radically reduces your financial risk.
Okay.
Think about the traditional Silicon Valley model. You raise millions, you guess what the market wants, you build the software, and you pray you find product market fit before the money runs out.
And usually you run out of money.
Exactly. The agency to SaaS model flips that completely.
Yeah.
You go to that roofing executive and you do not sell them AI.
Right.
You sell them the outcome. You say, I will guarantee a 24-hour turnaround on your estimates. I'll charge you $50 per completed estimate. If I'm wrong, I eat the cost.
So you're selling a magical result, but behind the scenes, you're faking it. It's a Wizard of Oz AI.
Yes.
You don't actually have the autonomous engine built yet. You just hire a smart college student, you use off-the-shelf measuring tools on the PDFs, do the math in Excel, and email back the quote.
Exactly.
Isn't that just lying to the customer?
Well, it's reframing what the customer is actually buying. They don't care if a neural network or a smart college student did the math.
True.
They care that the estimate is accurate, fast, and costs less than their internal bottleneck.
Right.
The business owner gets incredible value, but more importantly, while you are getting paid $50 an estimate to do manual labor, you are secretly funding step 3.
Which is building your data moat.
Exactly.
Right. Here's where it gets really interesting. Because every single time you manually complete an estimate as an agency, you are generating perfectly labeled, highly structured training data.
Yes, you have the original messy PDF, the exact measurements taken, material calculations, and the final accurate bid.
So if you run this agency for, say, 6 months and you manually process 5,000 estimates, you now possess a pristine proprietary data set.
Showing exactly how human experts solve this highly specific problem.
A data set that literally no one else on Earth has.
Right. Code isn't a moat anymore. A slick user interface definitely isn't a moat.
No, anyone can copy a UI.
But a crystallized digital repository of industry expertise. That is incredibly difficult to replicate.
Okay, wait, I have to challenge you on this though.
Go for it.
If the underlying AI model is open source and a competitor has, say, 10 million in VC funding, why can't they just hire 100 people offshore to manually label roofing data for a month and instantly copy your moat?
That is a great question. And the answer is a concept called human in the loop, which is how you operationalize that data moat.
Human in the loop.
Yeah, it's not just a static pile of data. Let's say you transition your agency's internal tools into actual software, right? And you give it to the client. Now, the AI isn't perfect yet. It misidentifies a skylight thinking it's an HVAC unit.
Okay.
What happens? In a standard wrapper, the user deletes the bad output, types in the right answer, and moves on. The AI learns absolutely nothing.
It makes the exact same mistake tomorrow.
Right. But in a defensible vertical AI system, you design the interface to capture that correction. When the human overrides the AI's guess, changing that HVAC unit back to a skylight, that specific interaction is trapped. The system takes the original image, the AI's incorrect guess, and the human's correction, and feeds it directly back into the model for continuous fine-tuning.
Oh, wow. So the system gets organically smarter every single day it is used in a live workflow.
Yes. So if that well-funded competitor tries to enter your niche a year later, they might have capital, but they don't have the workflow integrated continuous learning.
They don't have the reps.
Exactly. When their raw AI looks at a smudged blueprint, it hallucinates. When your AI looks at it, it recognizes the pattern perfectly because it has seen it 10,000 times and been corrected by actual roofing experts.
That is brilliant. That is how you build a moat that money can't immediately buy.
Absolutely.
Okay, so you have the data moat, the internal tool is flawless, and now you execute the pivot. Step 4. You go back to your agency clients and say, instead of paying us $50 an estimate, we're giving your internal team access to our software platform for a flat $2,000 a month. You transition from a service agency into a true SaaS company.
Exactly.
But wait, if your roofing AI is so efficient that the company can fire 3 estimators, aren't you cannibalizing your own SaaS subscription? Because traditional software charges per user, per seat. If you eliminate users, you eliminate your own revenue.
And you've hit on the core structural problem of traditional software in the age of AI. The entire value proposition of AI is that it eliminates the need for human seats.
Right.
Charging per seat creates a completely perverse incentive structure.
Yeah.
Your revenue goes to zero exactly when your product is delivering the maximum value to the client.
That makes no sense.
It doesn't, which is why the final step of the playbook is shifting to outcome-based pricing.
Which also has to do with how much it actually costs to run an AI company, right? Because
Yeah.
the unit economics are totally different.
Fundamentally different. In traditional SaaS, adding one more user to a cloud database costs essentially zero. But in AI, every time a user uploads a massive architectural blueprint and asks the model to reason through it, you are burning GPU compute. You are consuming API tokens.
Let's clarify API tokens real quick, because it's not like a gigabyte of storage. Think of a token like a unit of electricity, right?
Yeah, that's a good way to look at it.
Every word or pixel the AI reads or writes costs a tiny fraction of a cent.
Exactly. So if you charge a flat $50 monthly subscription and you get a power user who uploads 500 massive blueprints in a week, your underlying compute costs will vastly exceed your flat fee revenue.
You will literally go bankrupt by scaling your own business.
Yes, you will grow yourself to death.
Yeah.
So to fix that, the playbook dictates outcome-based pricing. You charge a platform fee, say $500 a month just for access, which covers your fixed server costs.
Yep.
And then you attach a microtransaction for every one contract. If your AI helps them accurately bid and win a $200,000 roofing job, your API automatically captures a tiny percentage of that massive win.
Oh, that's smart.
Or you charge per compute unit. You sell them credits. 1 credit equals 1 fully processed blueprint. They buy a bucket of credits every month.
So this mathematically tethers your revenue to your direct compute costs, which completely protects your margins.
Exactly.
And psychologically, this changes everything for the buyer, because you aren't an IT expense anymore. You are a direct cost savings mechanism.
Yes.
When a recession hits, CFOs ruthlessly cut software subscriptions, but they do not cut the software that is mathematically tethered to generating their top-line revenue. It makes the startup virtually recession-proof.
It shifts your product from a luxury to an absolute operational necessity.
Okay, but I have to stop us here, because we're making this sound like a guaranteed paved road to millions, which I know is never true in tech.
No, definitely not.
So if the math is this foolproof, why are AI startups failing every day? Where are the bodies buried here?
Yeah, we have to talk about the dark side.
We need to look at the dark side of the 2026 AI landscape, because this is where founders are actually losing their shirts. What is the first major existential risk?
The primary existential threat is what we call API dependency and margin squeeze.
A margin squeeze.
Yeah. Even if you are fine-tuning models for your specific vertical AI, you are inevitably going to rely on third-party infrastructure. You rely on AWS or Azure for your raw compute power. You rely on third-party APIs just to ingest the PDF data.
Wait, for those who aren't deeply technical, the source had mentioned relying on a vector database to give your AI memory. What does that actually look like? Is that just a standard hard drive?
Not quite. Think of a standard database like a highly organized Excel sheet, right?
Right.
Rigid. A vector database maps concepts by their mathematical relationship.
Oh, okay.
It allows the AI to remember that a skylight and a roof hatch are conceptually related, even if they're
Yes.
spelled completely differently. But you don't build that database yourself. You're rented from a massive cloud provider. So you are the captain of the ship, but you absolutely do not control the ocean.
But if I'm just renting compute from Amazon or OpenAI, aren't the prices pretty stable? I mean, if my code is just passing data back and forth, shouldn't my margins be somewhat predictable?
They are stable until they aren't, and that is the danger.
What do you mean?
A startup could be humming along with incredible 80% gross margins. But on a random Tuesday, a critical API provider changes their terms of service.
Oh.
Or they hike their pricing structure for a specific model you rely on. Or worse, they deprecate the model entirely, forcing you to use a newer, much more expensive version.
And you have no say in it.
None. Instantly, those 80% margins can be wiped out. Suddenly, every time your customer uploads a blueprint, you are actively losing money.
That is terrifying. So what are founders actually doing to survive that margin squeeze?
They have to become obsessively paranoid about their infrastructure costs. You have to build complex caching systems.
Meaning, if a user asks the AI the same question twice, you serve a saved answer instead of paying to compute the logic all over again.
Exactly. And you have to learn how to quantize your models.
Let's explain quantization real quick. Think of it like taking a massive high-resolution photo from a professional camera and shrinking the file size so you can text it to a friend over a weak cellular connection.
Right.
You lose a tiny bit of crispness, but it travels 100 times faster and costs vastly less data.
Yeah, you have to do that mathematical compression to your AI models.
Yeah.
Or the sheer weight of the server costs will literally crush your business.
That makes total sense. But even if you manage the compute cost perfectly, you still face the second major threat from our sources.
Yes, the churn trap.
The churn trap. And this isn't even a tech problem, it's a fascinating human psychology problem within B2B sales.
It really is.
Because an executive buys your vertical AI tool for the novelty, right? They read an article in Forbes, they want to be seen as cutting edge, so they sign the check, and they force their company to adopt your commercial roofing AI.
But the executive isn't the one actually using the tool.
Exactly. The mid-level managers and the estimators are. And we've all been there. You have a system that works for you, even if it's clunky, and management forces some shiny new software on you.
You immediately look for reasons to hate it.
You resent the disruption. And because no AI is perfect on day one, these mid-level managers will actively hunt for edge cases where your AI fails.
Oh, they'll document it. They will screenshot those failures, compile them, and complain to the executive sponsor that this new tool is actually slowing down their workflow.
And then what happens? When the annual contract comes up for renewal, the company churns. They cancel the subscription because the internal resistance was just too high.
Exactly. So how do you beat a mid-level manager rebellion?
Right. How do you fix that?
Your AI cannot just be, quote unquote, a better way to do the work. It must be completely invisible.
Invisible.
Yes. If your AI requires the estimator to log into a separate unfamiliar dashboard and learn a new interface, you will fail.
This is friction.
Right. The AI has to integrate seamlessly into the tools they are already opening every single morning. It has to live inside their existing email inbox, their existing CRM, or their legacy ERP system.
So it must operate silently in the background, extracting the PDF data and delivering the finished estimate directly into the workflow they already trust.
Precisely. The battle for B2B AI retention isn't fought in the neural network. It's fought in the UI and the integrations.
If it feels like new work to use your AI, they just won't use it.
Exactly. And this friction, this constant battle, leads us to perhaps the darkest part of this entire ecosystem.
The human story.
The human story. The founder's fear and the brutal psychological treadmill of building in this space.
Let's really dig into this, because founders are burning out mentally rather than just running out of cash. And it's because the velocity of AI innovation right now feels completely unnatural.
It is a war of attrition on the human nervous system. Let's look at a realistic scenario for a solo founder. They spend 3 agonizing months building a highly specific custom feature for their vertical AI. Let's say it's a novel way to parse terrible handwriting on physical blueprints.
Okay, a really hard problem.
Very hard. They finally get it working. They are exhausted but proud. Then they wake up on a Tuesday morning and check ARFIF.
ArcFIF, the open access repository for academic research papers.
Right. Someone at Stanford or MIT just published a massive breakthrough paper on vision language models that solves the exact problem the founder just spent 3 months on. And they are giving the code away for free.
Wow. So their unique intellectual property is commoditized overnight by an academic institution.
Overnight. And it doesn't stop there. Because the pace is so incredibly fast, by Friday of that same week, a well-funded competitor has already read the paper, integrated the open source code, and launched the feature to their users.
Oh my God, it took 3 days to wipe out 3 months of a solo founder's runway and morale.
Yeah. You are trying to build a stable, enduring company on a tectonic plate that is violently shifting every single week.
How does anyone survive that?
The mental endurance required to deal with that volatility is staggering. You have to maintain a monk-like discipline to remain focused on your unsexy vertical. Just commercial roofing, day in and day out.
While the entire internet and all your peers on social media are screaming about the newest viral AI demo that generates, full cinematic movies from a single text prompt.
Yes, it's the ultimate shiny object syndrome, weaponized by the fastest moving technology in human history.
And the psychological toll is just immense. Founders lose that discipline. They start feeling this existential dread that they are missing the bigger picture.
Right. The FOMO is real, so they pivot. They abandon their highly profitable, boring niche to chase the viral horizontal hype.
And they end up dying in the general purpose wasteland we talked about at the very beginning.
Exactly. They burn out, not from a lack of capital, but from a total collapse of psychological resilience.
Man, and this actually brings us to a massive contrarian take from the research.
This raises an important question about how we define success right now.
Right, because we are constantly told that the ultimate goal of a tech startup is to raise venture capital, get on the cover of Forbes, achieve $1 billion valuation, and ring the bell at the IPO.
Yeah, the classic Silicon Valley dream.
But this playbook argues that the entire Silicon Valley ethos is fundamentally wrong for 2026 AI startups.
It is entirely the wrong model for this specific technological wave. The venture capital model is a binary high-failure gamble. When you take VC money, you are forced into toxic dilution.
Meaning you give up massive chunks of your company's equity.
And you give up control. But more importantly, you are forced to hyperscale. You have to swing for the fences and try to become a unicorn, or the VC firm writes you off as a failure.
But if you are building vertical AI for commercial roofing, the total addressable market might only be $50 million.
Right.
A venture capitalist looks at that and said, well, it's too small, this won't return my fund, I can't invest.
And the contrarian stance of this playbook is that is a feature, not a bug.
I love that.
The new goal for the 2026 founder is not to build a flashy, cash-burning behemoth that needs public markets to survive.
The goal is building a boring, highly efficient $10 million machine that you completely control, with minimal headcount and maximum margins.
Exactly, a $10 million jewel.
But wait, if you aren't going public and you aren't trying to sell the company to Google, how do you actually realize the wealth? What is the exit strategy for this boring machine?
Because eventually you want to cash out.
Right. The 10-year outlook from our sources points to a completely different financial endgame. Micro private equity.
Yes. The landscape of private equity has fundamentally shifted to absorb these companies. We are seeing the massive rise of micro PE firms and specialized holding companies that have realized vertical AI startups are the absolute perfect acquisition targets.
Okay, let's break down the thesis there. Why does a PE firm want a roofing AI?
Well, these firms are not looking for consumer-facing AI that burns cash on customer acquisition. They want highly profitable, deeply embedded B2B tools that dominate a specific, localized niche.
Okay, so let's go back to our example. You built the commercial roofing AI. You are generating $5 million in annual recurring revenue with 80% gross margins.
Right. A micro PE firm will come in and buy your startup for a multiple of your profit. Let's say a 6x multiple.
So they buy it for $20 or $30 million.
Yes. And because your software business is highly automated and requires very little human capital to maintain, the PE firm can easily finance that acquisition using debt.
Wow. So they pay you, the founder, a massive cash payout at closing. You get your generational liquidity.
You're done. But here is the brilliant part of the 10-year roll-up strategy for the PE firm. They don't just sit back and run your roofing software.
What do?
They take your exact software architecture, your underlying code base, and your proven playbook for building a data moat, and they instantly clone it.
Oh, I see. So they strip out the roofing-specific data and say, okay, let's swap this out for landscaping data.
Exactly. They build or acquire the AI estimating tool for commercial landscaping, and then they clone it again for commercial plumbing and commercial HVAC.
That is wild. They use your proprietary architecture as a template to rapidly dominate 10 adjacent unsexy niches.
And they roll all of these micro SaaS companies into a massive, highly diversified AI holdings portfolio.
It's a localized monopoly strategy applied to software.
It is. And for the solo founder, this means you can walk away wealthy in 3 to 5 years. You don't have to deal with the toxic dilution of late-stage VC rounds.
You don't have to be the CEO of a public company dealing with grueling quarterly earnings calls.
Right. You architect a highly efficient machine, dominate your little niche, sell to micro PE, and cash out entirely.
It's an incredibly pragmatic blueprint for wealth creation that completely bypasses the traditional Silicon Valley gatekeepers.
It really is.
We have covered incredible ground today. Let's land this plane with a 3-bullet recap of this entire MediaGenX deep dive.
That's good.
Bullet 1. The consumer AI wrapper is completely dead. But vertical AI, targeting legacy B2B workflows with custom outcome-driven models, is the new trillion-dollar market.
Absolute.
Bullet 2. Use the agency to sauce Trojan horse. Do not build software in a vacuum. Sell the outcome as an agency, execute manually to get paid, and use that process to build an unbreakable proprietary data moat through continuous human-in-the-loop feedback.
That feedback loop is everything.
And bullet 3. Ditch seat-based pricing. AI naturally eliminates human seats, so you must transition to outcome-based pricing or compute-based credits to make your software recession-proof and protect your margins from API dependency.
Perfect summary.
But before we go, chew on this. If micro PE firms successfully execute this playbook and roll up all these vertical AIs into massive holding companies over the next 10 years, do we eventually just end up with a silent AI monopoly that runs the operational backend of the entire blue-collar economy? Drop your thoughts in the comments below.
It's a fascinating structural shift. We are watching the automation of the management layer in real time. It really is. And speaking of massive structural shifts, you won't want to miss our deep dive next week.
Oh, next week's going to be good.
We are moving from the digital startup into the physical portfolio. We're doing a massive breakdown of the AI real estate roll-up part 2. We're going to look at autonomous property management, how predictive maintenance algorithms are allowing solo investors to manage 500 units with 0 employees.
0 employees.
The death of traditional property managers and the rise of the algorithmic landlord.
The unit economics on that real estate shift are going to be staggering to unpack.
It's going to be wild. If you got value out of this playbook today, hit subscribe and share this with an aspiring founder who needs to stop building wrappers and start building a moat. Stay curious, stay positioned.
And as always, a mandatory reminder, this deep dive is educational commentary. It is not financial, legal, or investment advice. Do your own research.